That's a bit of a warm-up for our conversation to come with Trent Primmer. He's joining us from Barclay Pearce Capital. Trent, always good to see you. Thanks for coming in.
Thank you for having me.
What do you guys make of all of the, big outsized moves in markets this week?
Yeah, it's interesting. I mean, I think this market will be, obviously we're in a bear market. I think it'll be an interesting case study for future markets. Obviously, there's a lot of uncertainty right now. You've got high inflation, geopolitical tensions bearing on the market, fears of recessions. You've got China's lockdowns, issues with port capacity out of China. I think just recently, the head of toll logistics, their logistics division said that the Shanghai port congestions will probably continue into 2023. That's causing obviously supply bottlenecks. It's a little bit of a concern for commodities in particular, and there's obviously shortages of products coming out of China and not much going in and out of China at the moment. So a lot of things weighing on the market. Our view is that it'll stay relatively stable and trade sideways for the next 6 weeks. And then you'll see further sell-offs. And I think it's just good to position your portfolio defensively.
Just on that, Trent, what is forming the basis of that opinion that we'll trade sideways for the next 6 weeks or so?
I think, you're seeing a lot of the liquidities dry up in the small cap sector. You're still seeing big volumes in the larger cap space. There's still opportunities. I think people haven't cottoned on that, they haven't really come of the view that we're in a solid bear market, and a lot of people buying those dips and being quite confident with where they're buying at. I don't think they're looking at a good long-term view. What we see is markets will probably still trade off that positive sentiment leading into end of financial year, and then the catalyst will be tax loss selling, and there's probably going to be a lot of losses for people to start realising and selling out of on their portfolios. I think that'll be the catalyst. Yeah.
So, Trent, before we get to the buying opportunities, when we get this expected pullback coming through, what are some of the areas right now in this 6 week window we've got that you'd be looking to go and trim some positionings? What would you be trimming?
Industrials and banks, consumer discretionary. I think just positioning yourself out of some of those heavily weighted sectors on the ASX is probably worthwhile, because if you get really massive falls, obviously the heavier weighting sectors like banks, industrials, they'll sell off quite a bit. Where we'd position ourselves aside from that would be still in commodities, but not overexposed. Companies that offer you yield, so that while you're holding these businesses in your portfolio, like your BHPs, your Rios, your Fortescues, you're getting some good value, some good yield there for your portfolio. You're getting paid to hold these positions basically. And aside from that, looking in the energy sector, and obviously resources as a whole, but some of the rare earths companies, Arafura Resources is one in the rare earth space, and copper and cobalt, nickel, Panoramic Resources comes to mind as well. And in terms of the energy space, Woodside and Beach Petroleum, that's what we've been buying, and we've done quite well off them. We're comfortable. We're holding about 40% cash still. And we've held some good gold positions in Northern Star, which haven't done much. But if you saw the sell-offs in cryptos recently, a lot of people were looking at crypto as a hedge against corrections and market sell-offs. We're seeing that that's not true. They trade like a crypto proxy to the NASDAQ more so than a hedge against, say, an inflation or a down market. So.
Can you flesh out your position about gold right now? Because, there's a lot of sort of unknowns as to why the Australian gold miners have not performed better.
A big proponent, I think, is the focus in the rare earth space and people selling out of those. Typically, a lot of Aussies were probably holding some good gold positions. You weren't getting any returns there when inflation was running rampant, and it still is. Normally, with that coupled with geopolitical tensions, a market running hot, which is due for a correction, you'd see gold trading, in line with that rather than selling off. So it's got an inverse correlation at the moment, which is strange. If you're someone that's holding those positions, what would you rather? Returns that you're seeing, which are sustained in the rare earth space, or sticking with your gold and sticking to your guns, so to speak. I'd like to play both. I'd still like to have my gold positions in there as a hedge against my portfolio, but I still want to get some of those healthy returns that you were seeing in the rare earth sector.
What about the technology space? It's been hit pretty hard.
It
More
has.
other most at the moment. Some companies are great. Some companies have got a question mark over them still. What do you see in that area of the market that looks appealing at this stage?
Look, if you've held heavy tech, you've got tears in your eyes at the moment. Everything's getting hammered, which is understandable, but I suppose the question on everyone's mind is, where does it stop? If you're a short-term trader, you'd have to be pretty ballsy to go in at these levels and start value picking and picking bottoms in some of these companies. You saw Xero selling off, 18, 20% the other day off weaker guidance. A lot of these companies are reaffirming weaker guidance, and they're moving into earnings downgrade cycles. But in terms of value, yeah, there's a couple. Altium, Appen to some extent, Xero for sure. Those domestic names I'd be looking at, but you've got to be prepared to hold these names for probably 12 months or more. I'd be concerned if you're buying these things for a quick turnaround, or you're trying to make a quick quid here or two. You can get caught out doing that. So.
Yeah, it doesn't sound like you're rushing to get into any of those names.
Not at all. No.
Yeah.
I'll stick with what I know, and that's long-term investing, being comfortable, having some good exposure across sectors that are moving, but not having too much concentration on particular names. You want a well-balanced portfolio, still some diversification, but hold some cash. Keep your powder dry for some of those value opportunities, whether that's coming in the tech sector or other sectors. We've just got to see how the broader market plays out and deal the cards with what we're dealt. So.
Yeah, 40% cash you mentioned, that's a lot compared to a lot of people we speak on the program. How does that sort of rate compare to what you'd normally be holding on the books?
Normally we'd probably be holding around 10 to 20% maximum.
Yep.
I think this market's got us a little nervier. The rally that we've seen in this market has just been phenomenal. But then the negative sentiment and a lot of the issues that we're dealing with as investors right now historically haven't been seen. It's a melting pot of bad news out there, and the inflation rate that you're seeing come through has been, decades highs. These are worrying for the market where it's at. It's due for a correction. I don't think there's a tried or true amount of cash you should hold. People are worried that if they're holding too much cash, then they're not getting a return on it. But I say, if I'm holding that cash, I'm not losing 20, 30% that I could lose in the market when it officially corrects, because we haven't seen massive falls yet. I think that's due to come.